Hi guys, I'm going to be going over tutorial 3 in this video. So for the written section, we're given some information, so let's go through it. Tiger Brands carries an expected return of 12.3% with a standard deviation of 9%. Exaro carries an expected return of 14.1% with a standard deviation of 11.5%. And Barloworld carries an expected return of 10.9% with a standard deviation of 8.6%. Additionally, Tiger Brands and Exaro have a historical correlation coefficient of 0.65. Exaro and Barloworld, it is 0.7, and for Tiger Brands and Barloworld, it's 0.5. Additionally, the beta of Tiger Brands is 1.08, the beta of Exaro is 1.18, and the beta of Barloworld is 0.93. The market, which is the JSE LC, carries an expected return of 11.2% at a standard deviation of 8.9%. The yield on the risk-free government bonds is 6%. So just take note of all that information. Definitely keep it right in front of you as we solve the following questions. Calculate the risk and return of the following portfolio. So we've got 60% in Tiger Brands and 40% in Exaro. So this differs from the questions that we were answering last week because we no longer have two assets being one being risky and the other being risk-free. This time we have two assets which both carry risk. So our formulas would be different. So in this case, the risk and return, the return will be exactly the same as it was in tutorial 2. So it'll be the weight of asset 1 times the return of asset 1 plus the weight of asset 2, 40% times the return of asset 2. And that's how we get our 13.2%. The variance of this portfolio is calculated differently. So it'll be, remember your formula, it'll be the weight of asset 1 squared times the standard deviation of asset 1 squared plus the weight of asset 2 squared times the standard deviation of asset 2 squared plus 2 times the weight of asset 1 times the weight of asset 2 times standard deviation of asset 1 times the standard deviation of asset 2 times the correlation coefficient between asset 1 and asset 2. That'll basically give you the variance. So plug that all in your calculator and then square root it, and you will get a standard deviation of 9.089%. So that's your risk for the portfolio. Calculate the Sharpe ratio for the portfolio in question 1. So remember your Sharpe ratio formula, expected return minus the risk-free rate over standard deviation. So 13.02, which we calculated above, minus the risk-free rate of 6% over our standard deviation of 9.089%. We get a Sharpe ratio of 0.7724. Question 3, if we allocate our risky portfolio across these two companies or assets, only what must our target weights be if we wish to minimize risk in the risky portfolio? So the answer is the minimum variance portfolio. Make use of formulas, and yeah. Question 4, for Exaro, calculate the portion of its total variance that is accounted for by its systematic variance. So the total variance of Exaro, it's your beta of Exaro squared times the standard deviation of, the variance of the market squared. So that's what we do to, the total variance. Let me start that again. The total variance of Exaro is the the beta of XRO squared times the variance of the market squared plus the this other part is another element of the risk. So systematic and unsystematic. So we just focus on the systematic part of the risk. Sorry about that. So we're just focusing on this beta squared XRO times the standard deviation times the variance of the market. Okay, so the beta is 1.18 squared times our standard deviation of the market squared, and we'll get this as our answer, 0.011029. Next is the multiple choice section. It's a very quick, well, much shorter one this week. So based on the outcomes of the table below, choose which of the statements are correct. So from this table, we're given 3 scenarios. We're given 3 securities, and basically under each scenario, so for scenario of a recession, for security A, the return is expected to be greater than the expected return. For B, the return is equal to the expected return. And for C, the return is less than the expected return. So it's like that for all 3 securities. Yeah, but it's just different depending on the scenario. So based on the table, which of the statements are correct? So the covariance of security A and security B is 0. So covariance, that's to do with how they move with each other. So like, if it's 0, it means that they're completely unrelated. So if we compare A and B, in the recession, A is the return is greater than the expected return for A, and for B, the return is equal to the expected return. For the normal scenario, they're the same, and for the boom, it's different again. So that is true. Their covariance is 0. And 2, the correlation coefficient between A and C is negative. So negative correlation, if you can think if one goes up, the other one will definitely go down. They basically move in opposite directions. So return is greater than expected return, return is less than expected return. Return is less than expected return for the boom, return is greater than expected return. So it does look like they're opposites, so that is definitely true. The correlation coefficient between B and C is positive. So B and C, if it's positive, they'll both move in the same direction, maybe like at a different rate, but it doesn't look like it is related. So it looks like our answer is B. Okay, the something is equal to the square root of systematic variance divided by the total variance. So the answer is B. Remember your formulas, guys. Asset A has an expected return of 20% and a standard deviation of 25%. The risk-free rate is 10%. What is the reward to variability ratio? Reward to variability, so this looks like it's the Sharpe ratio. So expected return minus the risk-free rate over 25%, which is our standard deviation. The answer is A. Then you put half your money in a stock portfolio that has an expected return of 14%, standard deviation of 24%. You put the rest of your money in a risky bond portfolio that has an expected return of 6.6% and a standard deviation of 12%. The stock and bond portfolio have a correlation of 0.55. The standard deviation of the resulting portfolio. So remember what I said earlier. we've got two risky assets, so let's calculate that. The weight of asset 1 times the weight of asset 1 squared times the standard deviation of asset 1 squared plus the weight of asset 2 squared times the weight of times the standard deviation of asset 2 squared plus 2 times the weight of asset 1 times the weight of asset 2 times the standard deviation of asset 1 times the standard deviation of asset 2 times the correlation coefficient, and then we'll square root all of that to get the standard deviation of 16.1%. So our answer in this case is C. The optimal risky portfolio can be identified by finding blank the minimum variance point on the efficient frontier. No. The maximum return point on the efficient frontier, the minimum variance point on the efficient frontier. No. The tangency point of the capital market line and the efficient frontier, that is true. The line with the steepest slope that connects the risk-free rate to the efficient frontier, that is also true. Number 6, a portfolio is composed of two stocks A and B. A has a standard deviation of 24%, B has a standard deviation of 18%, A comprises 60% of the portfolio, B makes up 40% of the portfolio. If the variance on the portfolio is 0.038, the correlation coefficient between the returns on A and B is, so they give us the variance, which is equal to, again, making use of our formula, weight of 1 squared, standard deviation 1 squared, plus weight of 2 squared times standard deviation of asset 2 squared, plus 2 times the weight of 1 times the weight of 2 times standard deviation 1 times standard deviation 2 times our correlation coefficient. All I do now is I solve for our correlation coefficient rho, and I'll get the answer 0.583. Consider two perfectly negatively correlated risky assets A and B. A has an expected rate of return of 16% and a standard deviation of return of 20%. B has an expected rate of return of 10%, standard deviation of 30%. The weight of security B in the minimum variance portfolio. So just remember your formulas, guys, as I've said before. So the weight of B will be given by this formula here. It's just your variance of A minus your covariance between A and B over your variance of B plus your variance of A minus 2 times your covariance between A, B. All you do is you plug in your numbers. Remember here, it's saying that we've got two perfectly negatively correlated securities. So if they are perfectly negatively correlated, their correlation coefficient will basically be -1. So plug in the numbers and you will get your weight of B as 40%. An investor can design a risky portfolio based on two stocks A and B. The standard deviation of return on stock A is 24%, while the standard deviation on stock B is 14%. The correlation coefficient between the return on A and B is 0.35. The expected return on stock A is 25%, while on stock B it's 11%. The portion of the minimum variance portfolio that would be invested in stock B is approximately, again, we're making use of that formula that we saw above, so the weight of B. The weight of B is equal to the variance of A minus the covariance between A and B, all over the variance of B plus the variance of A minus 2 times the covariance between A and B. So to find the covariance between A and B, we can make use of the formula, which is the correlation coefficient between A and B times the standard deviation of A times the standard deviation of B, as we've done before in the previous question. So we've basically got our covariance here. Substitute that into the formula and solve for the weight of B. We'll get 85%. So the answer for 8 is C. Okay, a stock has a correlation with the market of 0.45. The standard deviation of the market is 21%, and the standard deviation of the stock is 35%. What is the stock's beta? So again, remember your formula for beta. It'll be your covariance between the return of the stock and the return of the market. So the covariance between the stock and the market all over the variance of the market, which is the same as saying the covariance of the market with itself. But anyway, covariance between the stock and the market, it'll just be your correlation coefficient times the standard deviation of the stock times the standard deviation of the market over the variance of the market. Plug in the numbers and you should get 0.75 as your answer. Which of the following statements is true regarding time diversification? So, the standard deviation of the average annual rate of return over several years will be smaller than the 1-year standard deviation. That is true. For a longer time horizon, uncertainty compounds over a greater number of years. So basically, as you go further and further into the future, your risk gets bigger and bigger, which is true. Time diversification does not reduce risk. That is also true. So the answer is D. You are thinking of investing in one of two assets. Asset A has a higher systematic risk than asset B. You can be sure that asset A's something return will be higher than asset B, but you can't be sure if asset A's something return will be higher than asset B. So the answer to this is C, and it actually makes sense if you read it. So A has a higher risk than B, so you can definitely be sure that the A's expected return will be higher than B, but you can't be sure if A's realized return will be higher than B, because it hasn't happened yet. So yeah, that's our answer. Anyway, thanks for watching the video. I hope this helped. I'll see you in the next one.